Good evening, good afternoon. This is Ron Clymer, and this is part of the First Real Estate School Black Shirt series. If you don't know what the Black Shirt series is, you need to watch it. Now, I want you to take a look at that problem that's on the board, and I want you to write it down because it's not going to be available for the whole video. But it says your client wants a before tax cash flow of $100,000 at his 40-unit apartment building. His taxes are $43,000 per year. His other operating expenses are $150,000. His annual debt service, which as you know is a fancy word for mortgage payments, is $117,000. His typical vacancy rate is 10% of his potential gross income. And your question is, how much rent must you get per unit to accomplish this? I'm going to read that again. Your client wants a before-tax cash flow of $100,000 at his 40-unit apartment building. His taxes are $43,000 per year. His other operating expenses are $150,000. His annual debt service is $117,000. His typical vacancy rate is 10% of the PGI. How much rent must you get per unit to accomplish this? Now, at First Real Estate School, we use the yellow book, and on page 488, there is a pro forma statement. And y'all forgive me, I'm operating here with no cameraman and just plenty of other obstacles, including, but we're going to show you how to do this if you'll let me. And let's see. So we're going to take a look at this. Now, what I'm pointing this camera at now is called a pro forma statement or an operating statement. It's called a pro forma statement or an operating statement, and you need this memorized. Now, you need this memorized, and forgive me, I got to set this out of the way. But you need this operating statement, also known as a pro forma statement, memorized. Now at the top is the potential gross income. That's how much the apartment building would rent for if it was 100% full 100% of the time. We subtract from that the vacancy and collection, and that gives us what we call the effective gross income, which is just a fancy word for a subtotal, if you will. We subtract from that the expenses of the property, and that gives us the net operating income. Now, if we were determining the value in an appraisal, this is as far as we would go. But this is not an appraisal, this is investment analysis. And so in investment analysis, we're going to subtract the debt service, which is a fancy word for the mortgage payments, and that gives us the before-tax cash flow. But in this problem, they give us the numbers, and we have to do the arithmetic backwards in order to figure out what's what. Now, it says our client wants a before-tax cash flow of $100,000. So you might call this the bottom line. So when we get to the bottom line, our client says, I want $100,000 per year in income after I make my payments. Well, his payments are $117,000. All right? His payments are $117,000. I'm going to erase that because y'all don't need to know that. Y'all already know that. So what we're going to do is take what we want to have left over at the end and add that to it. So we've got to have a net operating income of $217,000 in order to make the payments and have $100,000 left as before-tax cash flow, which, as you know, is also called cash throw-off. Well, our expenses we've got $150,000 a year in expenses, plus we've got $43,000 in taxes, which is an expense. So we've got, help me out here, $193,000 in expenses that has to come out of the rent before we get this net income, make the payments, and give our client $100,000. So we're going to take the 217 and we're going to add these two numbers to it. All right? Got my handy calculator here. I want you to do this along with me, or I'm going to do it along with you. We've got $217,000 in net income plus $150,000 in expenses plus $43,000 in taxes. Now those numbers could have been lumped together as one number, wouldn't have made any difference, but that means we've got to have an effective gross income of $410,000 in order to pay the expenses, get the $217,000 NOI, make the payments, and have $100,000 left for our client. So that's what we got to do. Now, the effective gross income, it tells us in the question that we have a 10% vacancy, usually, most of the time, around town. So we have a 10% vacancy. So we're not going to get 100% of this money. We're only get 90% of it. If we knew the potential gross income, which we don't, and we times it by 0.90, that would give us $410,000. Well, if we do that arithmetic backwards, $410,000 divided by 0.90, that'll give us the potential gross income that we have to get in order to come down to the bottom line that our client wants. So we're going to take the $410,000 and divide it by 0.90. All right, hold on. 410,000 divided by 0.90, and my calculator says $455,555. So we got to start out with a PGI of $455,555. Subtract, now by the way, if we were filling this out, minus 10%, which is $45,555. So if we subtract the 10% vacancy, those are apartments that are never going to have somebody in them about 10% of the time for some reason. That's going to give us the 410. Subtract our expenses. That's going to give us the net operating income. Subtract our debt service. Our client's got $100,000 in his pocket. He's a happy camper. We got a job next year. So that's the way we do that. We took the $100,000, we added the debt service to it, gave us the 217, added the expenses to that, gave us the effective gross income of $410,000, took the vacancy and collection and divided the 410 by 0.90, gave us this, and I just stuck that in there to check our work. But hold on, that's not the answer. That's the potential gross income. The question says, how much rent per unit? Okay? This is an annual figure. Well, first thing we do, I'm going to erase myself some space here. First thing we're going to do is take the $455,555 and divide it by 12 months. Let's turn that into a monthly figure. All right? Divided by 12 months. My calculator says $37,962 and some change as the monthly figure, monthly potential gross income, and we're going to divide that by the 40 units. We're going to divide that by the 40 units, all right? divided by 40 units, and I got $950 per unit per month. Actually, I got $949.07, but I think anybody in their right mind would round that off to $950, including the answer choices at the bottom. So let me run that past you again. We want to get 100,000 cash flow. We got 117,000 in debt service, so we add that back to give us 217 is the net income we have to get. We got expenses. We know we got to subtract the expenses from the effective gross to get here, so we add them back to get here. So we got 410,000 in effective gross, which is 90% of the potential gross. So we divide this number by 0.90, and it gives us 455,000 per year. We divide that by 12 months, gives us 37,962 per month, divided by 40 units, $950 per unit. So that's how you do that. I'm Ron Clymer. I'm at First Real Estate School in Hendersonville, North Carolina. And if you're going to get your North Carolina real estate exam, we'd love to have you as a student. If you're anywhere in Western North Carolina, our tuition's only $300. Of course, it might go up one of these days. I'm not going to change this video if it does. But give us a call. By the way, I said give us a call. Let me give you a phone number if you want it. Phone number is 828-440-1064. 828, that's Hendersonville, North Carolina, 440-1064. So if you're in Asheville or Tryon or Brevard or Toxaway or Highlands or Franklin or Murphy or Waynesville or Charlotte, come on over. We'd love to have you in our class. We're at 404 South Main Street. Thanks for listening. If you haven't seen the other Black Shirt series, you want to watch the Black Shirt series. This is the fourth one, I think. This is the fourth one in the Black Shirt series.